we're running out of extra dollars. And you can see that because the dollar supply is contracting, because the Fed counts it up to the dollar every month. And it's shrinking. So like, who's going to buy these auctions? I don't know. And what happens then? Something's going to break.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin specials for December 4th through December 11th, 2023, while supplies last. First, we feature Silver Eagles at $4.99 over spot, making this a great time to swap silver bars into Silver Eagles or to purchase Silver Eagles at the lowest premium in years. Next, Constitutional 90% silver is just $3 over spot per ounce. We also have 100-ounce silver bars at $1.45 over spot. And finally, $20 gold Liberty coins in AU condition at just $170 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Rafi Farber from the Endgame Investor. Rafi, thank you so much for joining us today.
Good to be back again, Elijah, and happy to talk to you anytime.
Well, it's great to have you today. I did want to discuss, I guess the elephant in the room is the precious metal markets, how we saw a huge spike in gold followed by a dramatic sell-off there on the Sunday night session, Monday morning in Asia. Your perspective on that, kind of what we've seen over the last couple days.
Well, I want to zoom out a little bit and just recognize that we're in a world today, you, me, everyone else, where we can see daily price moves, even minute to minute price moves all the time. So it kind of drives us wild. Like, if we hadn't had access to the internet and we weren't constantly involved in gold and silver prices every minute, every hour, every day, would we have even noticed that it broke to a new all-time high and then sold back down a day later? Like, it wouldn't have even been a thing. So we have to recognize where we are in the world and where we are in communications, and I'm part of it and you're a part of it. We can't really escape it. So, you know, did gold really go to a new all-time high? Yeah, on a daily trading basis, sure. But we really have to recognize that we're part of a much bigger picture than daily price moves here. Not to minimize it. I guess I am minimizing it, but I recognize it's important. But what I'm saying is more on a general level. Look, the money supply has been contracting since April 2022. What is that? That's like a year and a half. Okay. Gold doesn't usually reach new highs when the money supply, meaning the dollar supply, is contracting, and it still is, and it still will until the Fed moves in and starts to reverse it, which means it has to do QE again. It's got to print more money. It's got to buy more bonds, which it's not doing. So the fact that even on our microscopic level where gold is moving to new all-time highs on a daily or hourly basis, that's something big. So don't take the sell-off from all-time highs that seriously. The fact that we're moving even to nominal all-time highs on an hourly basis is a big thing, considering that the money supply has been dropping at a record pace since April 2022. And that's going to reverse. And when it does, so if I'm saying is a fortiori, if the gold price is moving to new all-time highs on an hourly basis, if you're in the spot market, then imagine what it's going to do when the Fed actually reverses and the dollar supply moves to new all-time highs past April 2022. It's going to be extreme. So this is just a warning, right? If you're really interested in gold and silver, then you'll buy now. I'm not saying anyone buy now. I'm just saying theoretically that you'll buy now while it's selling off after new all-time highs, while the money supply is shrinking. Like there's more here than just gold goes to all-time highs and then sells off. That's what's on the surface. Like, dig underneath and there's a lot more happening. That's my point.
One of the things that you've been reporting on, and we've had you on the show to discuss, is the reverse repo facility and how it seems like things are really coming to a head. You recently put out a video saying within about 13 weeks that could all dry up. Your perspective on that, because it seems like this facility that the Fed has been running has really been propping up the economy, even though the money supply officially has been contracting.
Okay, so let's try the same perspective here that I took in the last question. Let's zoom out a little bit. And I've been seeing justifiably on the internet, on our circles and gold and silver and monetary policy and money circles, people justifiably saying like all these experts have popped up in reverse repos and all of a sudden they know exactly what's going on in the monetary basement, and there were never any experts in here, and all of a sudden they just want to like get clickbait and they want to be famous. And like I get that. That's legitimate. It's a legitimate criticism, and I'm part of that because it's my living. I'm not trying to manipulate people. I'm just saying what I see. And if you zoom out a little bit, back during the repo crisis, the repocalypse of September 2019, right? So interest rates suddenly went up to 10%, and nobody really knew why. Not even Jamie Dimon, let's say, like the bankster of bankers, the most powerful banker in the world. He didn't like come out and say 3 or 4 days before, like, there's a problem in the repo markets, and I'm an expert in the repo markets, and this is going to happen, and I know it because I have a doctorate in this stuff. This is all new stuff that nobody has encountered before because central banks have never been this involved in the monetary spheres before. So yeah, it's legitimate to say that nobody's really an expert in this, and neither am I. I'm just looking at what has happened in reflection against what has happened in the 2 or 3 years in the past, because that's all we have to measure this. None of this is established. This is all just new money tools that are employed by major central banks that are using new tools themselves and using other new tools to try to balance it. So we're talking about a humongous pyramid here that's being balanced on both sides, and nobody really knows exactly what's going on. So just to get to your question more specifically, what's going on is from what I see, and I don't know any more than this, is that reverse repos are falling. And they're about to go back to zero. They fell $120 billion on December 1st, which is a new month, and they usually fall in the new month. And when they go back to zero, that means there's no extra cash. A reverse repo is when banks lend the Fed cash because they have extra cash and they get interest on that cash the next day. So when the reverse repos go back to zero, there's no extra cash. So then if there's no extra cash, then what do banks buy treasuries with? And now the objection is that, okay, well, fine, there's been no extra cash in reverse repos for many, many years, and the fact that reverse repos were at $1 trillion or $2 trillion a few months ago, so they were at zero many, many years before that, and nothing happened. Like, who cares? Okay, maybe, but they were at zero when interest rates were at also zero, which means the money supply was growing. But now the money supply is shrinking. So we've never been in a situation where all of a sudden reverse repos are at zero and money supply is shrinking and interest rates are 5% or near 5% or whatever they are. So nobody really knows what's going to happen when they hit zero. I'm assuming something's going to happen. Repos are going to restart. Something big's going to happen. We all know something big's going to happen in the next few months. If you want to be a more longer term, you could say years. I'm not on the years time frame, but I'm in the months time frame. So despite the objections that nobody's an expert in this, nobody really knows what's going to happen, there's something happening in the plumbing. And even Jamie Dimon didn't know what was going to happen on September 2019 when interest rates hit 10%. Something like that is going to happen soon. And nobody's going to know the day before, but it's going to happen. That I'll stick to that. I don't know which day, but let's look forward to it.
It seems like something is going to happen. The price of gold seems to be signaling that. When it comes to the reverse repo, and you're saying that it looks like it will be dried up in about 13 weeks or so, can you expand on kind of what this means for the financial system and what this also means for the treasury bond market?
Okay. So I'm just trying to work this out mathematically in my head. So if reverse repos are 0 at a time when interest rates are 5%, so who is buying all of these treasuries on the primary market in the treasury auctions? Where are the dollars coming from? If the dollar supply is shrinking, there's got to be new dollars to buy these treasuries, right? So they must be coming from somewhere. They're coming from the reverse repos. We know this because every time there's a new treasury auction, the reverse repos shrink, right? So they're coming from the reverse repos. So if there's no reverse repos, who bids on the treasury auctions? And maybe people can come up with another possibility when in 13 weeks. It's a rough estimate based on how fast they're shrinking. It could be 13 weeks, 15 weeks. It could be weeks off, but what does it matter? You know, we're talking about like a 50, 60 year fiat monetary experiment here. And we're talking like we're trying to get into a precision of weeks, and I can't really do it exactly. But okay, so let's say 13 weeks. So who buys these things? And the answer is I don't know. I mean, there's some theories out there of articles that I've read that the reverse repos, instead of people lending cash, instead of banks or money market funds, whoever they are, lending cash to the Fed, getting securities in return. So when they run out of cash, okay, so fine, they'll lend securities to the Fed in exchange for cash with which they'll buy treasuries, but then they have to return the treasuries to the Fed the next day. I mean, this thing becomes very, very tight. And again, like, I'm speaking as if I'm an expert, but I admit that I'm not, and because nobody really is, and even Jamie Dimon isn't, and because if he was, he would have predicted the repocalypse in 2019, but something like the repocalypse is going to happen again. And some kind of treasury auction is bound to fail if there's no money in the system to buy those securities. Exactly when that happens, I don't know, but I can see the same thing happening now. Not the same exact, but something parallel happening now to what happened back in 2019, because we're running out of extra dollars. And you can see that because the dollar supply is contracting, because the Fed counts it up to the dollar every month. And it's shrinking. So, like, who's going to buy these auctions? I don't know. And what happens then? Something's going to break.
Does it mean a reversal by the Fed if we see a failed treasury auction? And also, does it mean an increase in the money supply because of Fed action? Your perspective?
Yes, absolutely. It means a reversal by the Fed, because the direction we're going right now is down in the money supply. And if you're going down in the money supply and up in the debt supply, which borrows from the money supply, like, something is gonna snap here. You can't have more borrowing of money from a lower and lower money supply. Eventually, you have to grow that money supply in order to satisfy the borrowing. The question is when that break occurs and there's like a huge meltdown in the market of some sort, like happened in the repocalypse or happened in 2008. These are all just reiterations of the same thing. Then what is the extent of it, and what happens? Well. You know, if you, in just a very basic zoomed out sense, right? When the Fed creates more money, it gives it to financial institutions which loan out that money, which then have more debt that they need to be paid back. So they need more money to pay back that more debt, which means axiomatically almost that these institutions need the debt to expand exponentially. So when the next break comes and these institutions that need exponentially higher debt to pay back their own debt that they're buying from the Fed or from the Treasury or wherever it is, when they need that, then the Fed needs to print exponentially more money. And the question is what happens to gold and what happens to people who need purchasing power when that next round happens. Like, eventually the rounds become too extreme and people just dump the currency and then get ahead of the Fed. When hyperinflation can be defined in many different ways. One of the ways in the logic that we're speaking now is when the public gets in front of the Fed and dumps the money faster than the Fed can. The question that we all want to know the answer to is that going to be the next round, or is it going to be a round after? I think it's going to be the next round. Could it be the round after? It could be. I don't think it will, but whether I'm right about being in the next round or it happens, a year or two or three later in the round after that, I don't think it will. I'm just saying it's theoretically possible. I don't think it matters in the scheme of things, and I'm glad to be part of the people that are warning now, even if I might be wrong about now, because we're right, and people got to get out of this.
Now, there's also the secured overnight financing rate that you've talked about and are concerned about what this is signaling as well. Could you expand on that?
Okay, so I just looked at this a few days ago, and this is more into the bowels of what happened during the apocalypse. The secured overnight financing rate is, to put it simply, it's basically the repo market without the Fed. So a repo is when a bank, let's say a bank needs cash to balance its books for that night or to buy whatever securities it wants with that cash and to earn interest. Let's say it does that one night and it calls the Fed up and says, I don't have the cash I need, and none of the other banks have that cash, so I need the cash from you. So that's a repo because it's from the Fed. They create the money, they give it to the bank, and they take the securities in exchange. It's the opposite of a reverse repo, where the bank gives the Fed cash and the Fed gives the bank securities in exchange when the banks have extra cash. So the secured overnight financing rate is when this happens between banks without the Fed, because there's enough extra liquidity within the banking system itself for a bank to ask another bank for the cash instead of the Fed itself to create the new cash to give to that bank. So what I've seen, and this is not necessarily alarming immediately, is that the secure overnight financing rate, that repo rate between banks, has jumped like 6 basis points into December 1st, which makes sense because, again, at a new month, the first day of a new month or the last business day of the last month is generally a time when, for reasons I don't understand, and I don't think many people understand the exact reasons for this, but it tends to happen that at end months, these numbers tend to rise. So what I've also been noticing is that as the secure overnight financing rate has risen from, I think, 5.31 to 5.39, so like 8 basis points into the end of the month, the volume in that market, meaning how much dollars are being traded between banks, has reached all-time highs, which means many banks are desperate for extra cash. So then the question is, so if many banks are desperate for extra cash, and this volume is at all-time highs, so why are there reverse repos at all? And that's a question of, why are there rich people and poor people? Why are there people with so much extra money, and why are there poor people without any money? So why are there rich banks with like hundreds of billions of extra dollars, and there are these poor banks that need to lend securities to the Fed in order to borrow dollars? Because that's how the system. There's rich people and there's poor people, or there's rich banks and there's poor banks, especially with inflation the way it is. So what I'm seeing in the secure overnight financing rate is that stress is increasing, and what I expect to happen, and again I might be wrong because I'm really not an expert. I'm just looking at what I'm seeing now, and this is only 2 years old. If the reverse repos run out, and the repos in the secure overnight financing market are at all-time highs, like, well, where do they borrow from? Like, something, again, is going to break, and I don't know exactly what it's going to be, but I can look in the plumbing, and even if you're not a plumbing expert, you can tell if you have a clogged toilet, right? You don't have to be a plumber to say, oh, my toilet's clogged. Like, you could just look at it. So that's what I'm doing. I'm just looking at it, and I like it's like the story of the emperor has no clothes. Like, did it take a genius to say the emperor has no clothes? It didn't take a genius. It just takes someone to have the bravery to say, like, he's naked. Like, what do you want me to say? So it's the same thing I'm doing here. It's just scratching the surface and saying, like, there's something wrong here. So something's going to happen. The Fed's going to have to move. That's it.
Now, one other sign of a possible issue in the financial system is that a lot of big investors, it seems like, if you look behind the scenes, it seems like a lot of big investors are moving into precious metals. You recently analyzed the silver market and made the point where it seems like the retail side of things are quite slow, but on the major exchanges, big investors are jumping in. At least that's what the data shows. Can you expand on that?
Yeah, so I noticed that in gold and silver are moving. When we say gold and silver moving, we're usually referring to the spot price, the price that you see when you're looking at the gold futures or the silver futures, and they're at a higher or they're at a lower, whatever it is, it's the futures price that's referred to, and the open interest in the futures market has risen very fast, whereas the ETF market, meaning GLD, if you have like hundreds of thousands or even millions of dollars, or if you're a bank or you're a really rich investor, you're not really going to buy GLD or SLV. Maybe you will, but like if you have a lot of money, you're going to buy futures because that's where the leverage is, that's where the excitement is, that's where the real money is, and that's where you can actually get physical gold and silver if you're plugged into a brokerage that can deliver that future to you. And it's possible. I tried it and I got to a point, but I know that there are brokerages that do accommodate this. So if you're a big investor, that's where you will invest. And that's where the action is happening. Whereas in the SLV and GLD markets, the amount of gold and silver that those ETFs hold has not risen anywhere near its peak, which I think was in like 2021 or early 2022. They've fallen since then. So that means the retail investors, both in the paper markets, in the people who buy GLD and SLV to have dollar exposure to gold and silver, not necessarily physical gold and silver, but they want to earn more dollars. So they want to use gold and silver as a vehicle to earn more dollars. They're not really interested in the market right now. If they were, then we'd see the amount of gold that these funds hold go up, because that's what happens when more people are invested in GLD and SLV and they have to maintain their peg, like an informal peg to the futures market. Then they have to put more gold and silver into those funds in order to expand the share count, in order to keep the price level with the futures market. So the fact that gold and silver is the amount of physical gold and silver in those funds is falling means that the retail investors in those funds are losing interest. Also, in the physical market, we're not seeing that much. I mean, this is an interview to me, but I would ask you, Elijah, like, I know you sell with Miles Franklin, and I'm affiliated with him also. What's going on with them? Are you seeing more or less sales? And you don't have to answer that question. I don't want to put you on the spot or anything, but
the answer is a lot less in this time frame. Around the holidays, you're going to see less demand typically. It's picked up a bit here in December, but I would say sales are quite lower than they were obviously back in the March-April timeframe.
Right. So that fits with the data that I'm seeing, because I'm seeing a lot lower premiums in the physical market. Still a lot higher than average if we go back all the way to 2008, a lot higher, but a lot lower than has been recently, let's say since Silver Squeeze. So we're seeing a lot less interest in the physical market, a lot less interest in the paper market for retail, and a lot more interest in the futures market, in the primary derivative that leads all the other derivatives, like in the ETF. So we're seeing something start, right? And this is probably going to be followed by a financial crisis, which is might bring the spot price down in some kind of crunch, and then the Fed's going to act, and it's going to go boom, just like it did in 2008 and 2020, just a lot faster this time.
What should people be thinking right now? Obviously, we're seeing a lot of volatility in gold and silver, but those holding physical metal, a lot of people aren't there to trade the metal, right? If you're a trader, that's one mindset you can have. But if you're just holding the metal in your own possession, these price fluctuations shouldn't really have much of an impact. But what is your perspective on that?
They shouldn't, as long as you're not leveraged. And this is what I say all the time, like. If you understand what's going on in a broad sense, and the day-to-day movements are disturbing you, just like stop looking for a while. And I have to say this to myself also. Like, I'm also a victim of it. It's axiomatic that gold and silver are the money, and and the dollar is just a derivative of that. So if you own the physical, it's not that easy to pick up your physical stuff, which you have to like take into a car and carry physically, and move to a coin shop and then sell to them. Most people are not going to do this. People who want to trade gold and silver are trading GLD and SLV. It takes a button to click, and that's it, and it's done. And we already know from the numbers that we just discussed that they're not interested anymore. So look, there's going to be one more round of printing, and this is my opinion. And there's going to be one more round, because there's going to be one more financial crisis. It's going to be more extreme than 2008. It's going to be more extreme than 2020. And when it happens, the spot price of gold and silver is going to go crazy. I don't know, $2,500, $3,000 in a few nights overnight. I don't know. I'm just putting out numbers, but it could be that extreme. And when that happens, then only after that are you going to see people in the physical market start to get more interested, right? And it's gonna happen quickly. And then you're gonna see premiums go up and up and up, and you're gonna get calls off the hook, and people affiliated with different gold companies are gonna get calls off the hook. We're looking forward to that. And the danger is like maybe at the point where you say, someone who sells gold and silver, like, I don't want to sell anymore, I'm just because I don't want the dollars, then we'll know that we're in the end game. When gold and silver physical stocks are no longer for sale from people like you and me, that'll be it. And so we'll know, we're like sort of the operators of the end game in that sense, not to put us in like a pedestal or something, but we're just the functional operators of it, because we won't be able to sell anymore. And I think that's next, because I think the next printing round is going to be like something like 10 trillion, $5 to $10 trillion. And what's the difference between 5 and 10 trillion, It's going to be that extreme, and it's going to be that devastating for dollar holders, and it's going to be a big wealth transfer for gold and silver holders. And if it's physical, no one can take it away from you as long as you have it, hidden in a place where the government can't take it from you. And not to encourage anything illegal, but just be smart.
Well, Rafi, we really appreciate your time today. If our viewers are interested in learning more, where can they find you? And did you have any last thoughts for our viewers?
You can find me at the Endgame Investor. Just type it in. It's a service on Seeking Alpha. You can check out my Substack, where I give more long-winded, that's a bad connotation, but long philosophical treatises on the nature of money and what it is. You can check my Patreon, where I give a more biblical angle on what's going on. I do have a religious perspective on things for people who know me, and I'm sure many people watching this do. But yeah, my main service is the Endgame Investor, where I give a daily market commentary. And my last thoughts are, and I'm talking to myself and letting people listen, is stay humble. We don't know most of what's going on. We don't know what's going on. We can pretend, we can build stories in our head, but we don't know exactly what's going on. We know the general thing, like this is fake and we've got to move to real money. That much we can all agree on. Exactly what's happening in the plumbing, we can create stories, and I try to do it intelligently, and I try to do it that in a way that shares information with people. But I don't know any more than Jamie Dimon does, and he didn't know what happened in the apocalypse, but it's happened before, and I'm looking at the same things, and it looks like something is building. So I think you got a few months left. Exactly how many, I don't know, but be wise, be careful, keep your liquidity, keep your gold and silver, and stay humble.
All right. Thank you so much, Rafi, for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.